Gold is breaking records again. But what's really pushing it higher? And will it crash soon? Stick with me, because what's happening right now could directly affect your money. So, what's the deal? In the first half of 2025 alone, gold has skyrocketed by about 26%, even crossing the incredible $4,000 per ounce mark. Compared to this time last year, it's up a staggering 50% in many markets. That's the what, but let's get into the why. First, the US dollar has been weakening. When the dollar's value drops, gold becomes cheaper for buyers using other currencies, which naturally pumps up demand. At the same time, central banks all over the world are on a buying spree. They're stocking up on gold to diversify their reserves away from the dollar, signaling a major shift in global finance. Add in geopolitical tensions and economic uncertainty, and you have a perfect storm. During uncertain times, investors rush to safe haven assets, and gold has been the ultimate safe haven for centuries. Another huge factor is inflation and interest rates. Gold doesn't pay you interest, so when real interest rates are low, or when people expect rate cuts, gold becomes much more attractive than holding cash. That's losing value. Speaking of losing value, when inflation is high, people use gold as a reliable store of value to protect their wealth. And finally, let's not forget supply. New gold for mining is limited, so when demand surges like this, the price is nowhere to go but up. Now, it's not all sunshine and rainbows. What could reverse this trend? A strong rebound in the US dollar could push gold prices down. If central banks decide to hike interest rates or keep them high for longer, other assets that provide a yield become more appealing. Also, after such a rapid climb, a temporary pullback or correction from profit-taking is always possible. Some analysts are already warning that the market might be a bit overvalued. So, what does this all mean for you? Should you buy now? Well, many experts, including those at Goldman Sachs, believe there's still room for growth, raising their price forecast to nearly $5,000 by the end of 2026. A common recommendation is to allocate about 5 to 15% of your portfolio to gold as a hedge. You can choose between physical gold like bars and coins, or more liquid options like gold. Physical gold gives you direct ownership but has storage costs, while ETFs are easy to trade but less tangible. The key is to stay informed and be cautious. Gold is volatile, so think of it as a diversification tool, not a place to park all your savings. Gold is more than just a shiny metal. It's a mirror reflecting the state of our economy. Will it continue its historic climb, or is it correction on the horizon? This story is far from over. If you found this breakdown helpful, hit that like button and subscribe for more updates as the gold market evolves. Thanks for watching!